The content of this publication PPT do not necessarily constitute or imply an endorsement, recommendation or favoring by us. This publication is meant for general reading and educational purpose only. The statement explain concepts are of general nature and may not have any the part taken into account the particular objective needs circumstances of the individual user, reader, organization, institute. Thus, we do not assume any responsibility for any wrong move or action taken based on the information available in this publication. Thus, we do not assume any responsibility for any wrong move or action taken based on the information available in this publication. Therefore, before acting on or following the steps suggested on any theme, or before following any recommendation given in this publication, reader should consider seek professional advice. The publication contains information, statements, opinions, statistics, and materials that have been obtained from source believed to be reliable, and the publisher of the title have made best efforts to avoid any errors. However, publisher of this material offer no guarantees and warranties of any kind of the readers users of the information contained in this publication. Since the work and research is still going on, we do not warrant the totality and absolute adequacy of completeness of this information and material, and expressly disclaim any liability for errors or omissions in this information and material herein. By allowing this presentation, the presenters have generated permission for it to be uploaded and shared across various social media platforms and the official website of iCapital Academy and Corporate Advisory LLP. We do not accept any legal liability what whatsoever based on any information contained here by iCapital Academy and Corporate Advisory LLP. My name is Rohit Godse. By allowing the presentation, I grant permission for it to be uploaded and shared across various social media platforms and the official website of iCapital Academy and Corporate Advisory LLP. So today my topic is mastering financial planning and forecasting for business growth. So we will learn this in 8 modules. The first module will be Introduction to Financial Planning. Then second module will be Understanding Forecasting. The third module will explain the tools and techniques. Then fourth module is Building a Financial Model. In module 5, Budgeting and Forecasting Integration. In module 6, we learn strategic application in business growth. In module 7, we learn that what are the challenges and best practices. In the final module 8, we will final recap and have interactive activities. The first module is Introduction to Financial Planning. So, what is the financial planning? Financial planning refers to the structure process that every business must following to manage its money properly. It starts from estimating how much capital the business will need in the near or distant future, whether it is for a new project or expanding the operations or managing the daily expenses or dealing with unexpected or hidden costs which occur on any time. Once the business know how much money it needs, the next step is to decide whether the money will come from. It could be from loans, investor profits, or for past years, or any other financial source. This step is crucial because different sources come with different responsibilities. For example, taking a loan means you will need to repay with interest, while bringing in investor might means giving away some control of the company. After identifying the capital needs and source, the focus shifts to create financial policies, which are the rules or principles that guide how money will be handled. These policies ensure that company stays disciplined with its finance. It involves setting policies on how to buy resources, where and when should be money invested for the growth of the business, and how we can manage all money related operations like funding. In simple words, financial planning ensures that the business does not just earn and spend money randomly. It follows a proper, well thought out plan. This helps to reduce financial mistakes, control unnecessary expenses, and make sure that the money always we have enough money available for important business activities. It also builds confidence among stakeholders because it shows that the company is financial aware and responsible. What is the importance of financial planning? The importance of financial planning in any business cannot be overstated. It is one of the most critical building blocks for the business stability, growth, and long-term survival. This slide highlights that some of the most essential reasons why financial planning plays such a powerful role in business success. The first is help business plans for future growth. One of the main purpose of financial planning is to give a clear direction to the future of the business. Growth doesn't happen by accident. It requires careful calculation and preparation. Financial planning helps businesses set realistic growth targets and identify how much funding will be required to achieve them. For example, if business want to expand into a new city, it will need to plan for the cost of hiring new staff, renting or purchasing new property, then marketing in the new region, then they have to maintain supplying inventory. Without financial planning, such steps would be taken blindly, which increase the risk of failure. So financial planning helps to business plan for future growth. Then second point is ensures proper fund management. In any organization, money comes in and goes out constantly. If there is no proper management, funds may be misused, overspent, or lie idly without being invested productively. Financial planning ensures that every rupee is allocated wisely. It helps the business decide how much to spend on operations, how much should we invest in future projects, how much to keep as reserves for emergencies, and how much to pay out, for example, in salaries or dividends. This discipline ensures that there is always enough cash flow to keep the business running smoothly without any interruption. Then the third point is supports decision making and avoids financial shocks. Every business is faced with critical decisions from time to time, such as whether to launch a new product, buy a new machinery, or expand into a new market, or it will be cut cost during a slowdown. Financial planning supports all these decisions by providing an accurate data and forecasts. It helps the business owners and managers see that the full financial picture before taking action. It also helps to prepare for unexpected situations like a sudden fall in revenue, inflation, increased raw material cost, or economic downturns. In this situation, the financial planning helps the most. Instead of reacting in panic, a company with a good financial plan can respond calmly because it has already created backup options. So it supports the decision making and avoid the financial shocks to business. The fourth point that improve profitability and efficiency. Profitability it's just about making more money. It it's about making smart financial decisions and reducing waste. Financial planning helps it identifying areas where cost can be minimized, resources can be better utilized, and operation can be streamlined. Uh, in example, a planned budget may reveal that certain departments are overspending without adding enough value, or that raw material are being wasted due to poor inventory control. When such issues are corrected through planning, the business become more efficient. The same amount of input generates better results. That's leading it to higher profits to the business. Going to the next slide, objective of financial planning. In this, we will see that how first point that determining capital requirement based on business goal. This means identifying exactly how much money the business will need to meet its current and future goals. So that means every goal have whether means every goal whether it's operating a new branch, purchasing machinery, hiring staff, or investing in marketing has a cost attached to it. Financial planning starts by breaking this goal down into specific tasks and estimating that the financial resources needed for each. This helps the business avoid overestimating or understanding the funds it needed, which could either lead to the cash shortage or unused capital sitting idly. In second point, ensuring proper utilization of funds. One of these is very important because once the funds are arranged, the next step is to make sure that every rupee is used productively and for the right purpose. Funds should not be left unused in the bank account or misallocated to areas that do not bring any expected returns. For example, if funds were raised to build infrastructure but instead get used for excessive marketing, the core purpose of funding is not fulfilled. Proper utilization means using the money in a way that directly support the business strategy, creates values, and avoids unnecessary waste or duplications. Third point, maintain a balance between inflow and outflow of funds. It is important that the amount of money coming into the business, which is inflow through sales or service or investments, is enough to meet the money going outflow, such as salaries, raw materials, rents, and bills. Financial planning helps the company monitor this flow to avoid situation where expenses exceed incomes, which can lead to borrowing or even business failures. A planned approach ensures that the cash is available when needed and that spending does not exceed earnings. It could be go the business in loss. So it is important to maintain a balance between inflow and outflow of funds. The fourth point is minimize uncertainty and help in future growth. Uncertainty is a part of every business environment, whether it's due to market competition, economic condition, or internal operational issue. Financial planning does not eliminate uncertainty, but reduce its impact by preparing for business in different scenarios. By forecasting income and expenses, estimating risk, and creating contingency budgets, the company becomes more stable and confident in facing the future. It allows for smoother growth because the financial direction is already laid out. Types of financial plannings. First is strategical planning. A strategical planning is created for the long run and focuses on the big picture of where the company wants to be several years from now. It includes major initiatives like expanding to international markets, acquiring other companies, or launching an entirely new product line. These goals are high level and usually involve major investments and long-term commitments. Strategic financial plans give direction to the companies for future and influence all other financial decisions. Then second is operational plan. It is a short-term goals like between 1 year. And operational financial planning deals with the day-to-day running of the businesses. It includes short-term goals like managing payrolls, paying bills, maintaining stock levels, and controlling overheads. This plan ensures the business can function smoothly every day, weekly, and monthly. It focuses on regular transaction and short-term needs, and it's often monitored monthly or quarterly to make adjustment if necessary. Then the third is tactical planning. It is for medium-term goals like from 1 to 3 years goal. The tactical plan sits between the strategic and operational level. It includes goals that are too big for daily operations, but not large enough to be strategic. Example include entering a new regional market, setting up a new department, or running a long-term promotional campaign. Tactical planning translates long-term goals into practical actions by aligning departmental objective with a broader company's target. These are the types of financial planning. Going to the next slide, strategical financial planning. The first type of financial planning. We will go in deep about this. Like strategical financial planning is focused on where the company wants to be in the next 3 to 5 years or more. It includes financial decisions that have a long-term effect and require significant commitment of resources. Some of the key components of strategic financial planning include deciding where to invest large amount of capital, which new markets to explore, or whether to acquire or merge with another businesses. These decisions are made with the intention of ensuring a sustained growth over time. For example, a business may develop a plan today to expand their operation into a new country after 5 years later. The financial planning involved here will cover project cost, expected returns, risk assessment, and funding strategy for the expansion of the new operation in new country. In second, we see that operational financial planning. The operational financial planning is concerned with the everyday financial activities of the business. This including creating monthly or quarterly budgets, tracking routine expenses, and ensuring that there is enough working capital to meet short-term obligations. It involves setting detailed budgets for departments, managing cash flows, and making sure that resources are allocated efficiently. For example, if we see that planning for the next month's salaries or utility payments or inventory restocking are means all these are part of financial operational financial planning. This type of planning ensures smooth operations and help prevent any financial dispersion at the ground level. Tactical financial planning. The tactical financial planning bridge the gap between day-to-day operations and long-term vision. It focuses on activities that are set to be completed over the next 1 to 3 years. These activities are more focused and practical than the strategical plans, but broader than daily operation. Tactical plan often involve the budget decision at the departmental level, project-based cost estimation, and timelines for achieving specific goals. Like for example, we see that increasing the regional market share or launching a new service line. If the company wants to launch a new product line in the next 12 months, the tactical financial plan would cover costs like researcher and development, testing, advertisement, packing, distribution, and support. It would also estimate returns over the product's first year. In next slide, we see the steps in financial planning. The first step is to set business goal. It's define what the business want to achieve. The first and most fundamental step in financial planning is setting a clear and meaningful business goal. These goals represents what the business is aiming to accomplish in a specific time frame without knowing the end objective. It is impossible to plan finance effectively. Business goals can vary widely. They may include increasing sales by certain percentage, expanding into a new cities, or launching a new product, or improving customer retention. Every goal must be clear, defined, so the financial team knows that they are working toward. These goals should be specific, measurable, realistic, and time bound to ensure that financial planning aligns with the real business needs. Then the second point is estimate capital requirement. So that how much money is needed. Once the goal are set, the next step is to calculate the amount of money needed to reach them. This is called estimating capital requirement. The estimation must consider both fixed capital and capital. Fixed capital include long-term investment like machinery, buildings, or vehicles. Working capital covers short-term like everyday needs such as inventory, salaries, rents, and utilities. Estimating capital accurately is crucial because uh, underestimation can cause projects delay or failures, while overestimations can result in unnecessary borrowings of idle cash. The third point is decide capital structure, means equity versus debt. After determining how much capital is required, the business must decide how to raise that money. This is known as choosing the capital structure. The two main types of financing are equity and debt. Equity means raising money by selling ownership shares of the company, while debt involves borrowing money that must be repaid with interest. A company may choose one or a combination of both. The choice depends on factors such as cost of borrowings, desired controls, financial health, and risk appetite. For example, a startup may prefer equity to avoid interrupt payments, while an established firm might use debt to retain ownership. The fourth step is to choose source of funds, loans, investors, retained earnings, etc. Once the capital structure is decided, the business must select specific sources of funds. If the decision is to raise debt, the business needs to explore whether it will come from banks, NBFCs, or private lenders. If equity is preferred, then it could come from angel investor, venture capitalist, public issue, or partners. Another important source is internal funding, such as retained earnings, profit, profit from previous year that the company decided to reinvest instead of distributing as dividends. Each source, each source has its own benefits and risks. For example, like bank loans may require collaterals, while investor may demand equity and decision-making powers. The fifth step is plan resource allocation. After the funds are raised, the next critical step is to allocate them wisely. This involves creating a detailed financial budget and clearly defines how much money each department or project will receive. Uh, we should allocate money which is based on business proper means priorities, expected returns, and operational importance. For example, a company planning to launch a new product may allocate more fund to research and development and marketing than to administration. If poor allocation of resources can result in missed opportunities or overspending in non-critical areas. Effective budgeting also helps the managers may stay within the financial limits and compare actual spending with the plan. The sixth step is the monitor and adjust. Financial planning is not a one-time activity. After the plan is executed, it is essential to monitor results continuously. This includes reviewing actual financial performance compared to what was planned. This includes important metrics like revenue, profits, expenses, and cash flow are analyzed to check whether the business is on track. If there are deviations like lower than expected sales or higher than budgeted expenses, the plan must be revised. Timely adjustments ensure that the financial plan remains relevant and effective even as market condition means collapse or any market condition comes. The customer behaviors or internal uh, operational change comes. Going to next, going to next slide. Role of financial planning in business growth. Every business is founded with a vision, a clear idea of what it wants to become in the future. This vision may involve becoming a market leader, expanding into a new regions, introducing innovative products, or achieving sustainability. However, just having a vision is not enough. There must be a roadmap to turn into reality. Financial planning plays the role of the roadmap. It links the daily financial decision with the company's long-term ambitions. For example, if the vision is to expand into the three new states over the next 5 years, financial planning will determine how much capital is required, how to raise it, and how to allocate it effectively for brand setups, hirings, and marketing. It converts big picture ideas into actionable steps backed by financial discipline. Then ensuring sufficient funds for expansion and innovation. A company cannot grow unless it has enough financial support to funds that growth. Whether it is launching a new product, investigating in advanced technology, entering a new market, or increasing production capacity. Each of these activities requires money. Financial planning ensures that the business does not wait until the last minute to find fundings. Instead, it helps the business plan in advance, arranging funds and have them ready when needed. It also allocated funds for research and innovation so that the business stay competitive and up to date. Without financial planning, even profitable companies can face cash shortage when trying to scale or innovative. Helps manage risk through forecast and planning. Business environments are always changing. There are like demands may go up or down, new competitors may emerge, raw material prices may rise, or government regulation may shift. These changes come with risk, and financial planning helps in preparing for them. It involves forecasting possible outcomes, building alternative scenarios, and creating contingency budgets. For example, if a company forecasts that demand for its product might drop during a recession, it can reduce inventory and cut cost in advance. Risk management become more protective instead of reactive, and the business is better equipped to face uncertainty without panic or loss. Then they encourage discipline, budgeting, and cost control. A financial plan is not just about spending money, it also about managing it responsibly. One of the biggest benefits is that it introduces discipline into budgeting. Every department knows exactly how much it is allowed to spend and what money is meant for. This avoids careless or excessive spending over time. It helps the business track which areas are consuming more resources and which areas are performing efficiently. This control helps reduce unnecessary cost, improves accountability, and creates a culture of financial responsibility at all levels of the organization. Then helps attractive investor with a clear financial road. Investor wants to know that their money is in safe hands. Like any investor first see that how his money is used in the business. When a business presents a detailed financial plan, one that explains its goal, funding needs, projects revenue, and expected profits, it builds the investor confidence. It shows that the management is serious, strategic, and capable for handling funds wisely. A financial roadmap gives investor visibility into how their funds will be used and what kind of return they can expect. It also assures that the company is not just surviving on hope, but is actually planning for success based on real numbers. Then the next point, improve decision making with data backed analysis. When financial planning is done correctly, it becomes a powerful decision making tool. Instead of guessing or rely on assumptions, managers can base their decision on hard data. They can compare projects versus actual performance that evaluate different financial options and understand that long-term impact of every major business move. This brings logic and structure to the decision-making purpose, helping avoid emotional or risky choices. Whether it is entering a new market, cutting down cost, or launching a campaign, decisions are more informed, calculated, and likely to succeed. This helps the decision like we take in the finance with the help of financial planning. Going to next slide, next module that what is means understanding the forecasting. The first is what is forecasting. Forecasting is a technique used to look ahead into the future of a business by using data from the past and present. It involves examining past sales, seasonal trends, customer demands, and market movements to predict that the business might expect in terms of income, expenses, cash flow, and customer behavior. Forecasting is not about guessing. It uses logics, patterns, and statistics to give a realistic picture of what might happen in the coming weeks, months, or years. For example, if a retail business notices that sales always increase by 20% during festive season, if they see the pattern in the Diwali times, the pattern is going up 20% in sales, so it can forecast higher demand during these months and prepare its inventory and staff accordingly. This protective approach helps the business stay prepared instant or reacting late. This will be means beneficial to them. They don't will get panic at the time of the high sales. Then in second slide, what is the purpose of forecasting? The first is guide decision making with data. Forecasting give decision makers that the information they needed to make well-informed choice. For example, if sales forecast show a likely drop in revenue next quarter, the company can postpone unnecessary expenses. If forecast indicates strong growth ahead, it can prepare for expansion. Every small and big decision becomes sharper and more strategic when backed by forecast data. The second point is plan future operation and strategies. With forecasting, business can plan not just for today, but for tomorrow, next month, or even next year. It helps in preparing budgets, assigning staffs, managing stock levels, and setting sales targets. For example, a company can use sales forecast to plan its production schedule in advance, ensuring that it meets customer demand without overproducing. Like if we see that in many companies there is every time there is a shortage in stock, but if they do forecasting and plan for future, so there will be no shortage in stock. Then the third point is avoid financial surprises and prepare for challenge changes. Without forecasting, sudden changes in business condition can be financially damaging. A rise in fuel prices, a drop in demand, or a delay in supply or deliveries can cause chaos if there is no plan. Forecasting helps spot such risk early, so the company can prepare alternate strategies like increasing price slightly or finding alternative suppliers. The next point is improve resource and inventory management. Forecasting helps businesses plan how much material, manpower, and money they will need in the near future. If we see, for example, a clothing brand might forecast high demand in winter and place a fabric order in advance. It avoids both understocking and overstocking, which benefits him to reduce losses and keeps operation running smoothly. It is very beneficial for the cloth brands in the time of winter. In next slide, we will see that forecasting versus budgeting differences. So forecasting predicts future outcome based on data trends. The forecasting involves estimating what might happen in the future using past and present data. It focuses on spotting patterns and projecting future events. For example, if a company observes that its sales have been growing by 5% every quarter for the past 2 years, it can forecast that these trends may continue in the next few quarters. Forecasting is about asking what is likely to happen if current trends continue. Budgeting sets financial limit and plans for income and expenses. If we say budgeting is about setting limits on uh, how much money a company will earn and spend over a certain period, usually a year. It is detailed plan that outline expected income, available expenses, and allocation of resources across departments. Unlike forecasting, which predicts possibilities, budgeting defines financial boundaries. For example, a company may allocate rupees 10 lakh to its marketing department for the year and expect revenue of rupees 1 crore during the same period. The forecasting is flexible and updated regularly. Forecasting is an ongoing activity. As new data becomes available, forecasts are revised. This makes forecasting a dynamic process that helps a business stay responsive. For instance, if a company sees that its sales are rising faster than expected, it can revise its forecast upward and increase in production. On another side, the budgeting is fixed and used for performance evaluation. Once a budget is approved, it usually remains fixed for the period it covers. It serves as a benchmark against which actual financial performance is measured. Manager used it to control expenses and assess whether Teams are working within financial guidelines. Any major change in the budget usually require formal approvals. The forecasting is forward looking and the budgeting is goal setting. Like forecasting is about looking ahead at what is likely to occur based on changing trends and market conditions. Budgeting, on the other hand, is about setting goals and targets based on what the business wants to achieve. Forecasting says this what is expected, while budgeting says this is what we aim for. The budgets and forecasting similarities and differences. The budget is about set spending targets, estimating revenues and expenses, covers a specific for a specific year. On another hand, forecast is plans for future project trends and outcomes get regularly updated. They both identify risk and opportunities using historical data and trends. Uh, the short-term forecast. Short-term forecasting refer to prediction made for a relatively near time frame, usually anywhere from a few weeks to up to 12 months. These forecasts are highly useful for managing day-to-day and month-to-month operation. Business use short-term forecast to ensure smooth functioning. For example, they might forecast how much cash they will have to on hand next month, whether they need to hire temporary staff for the holiday season, or how much stock to keep ready based on seasonal demand. This forecast guides quick operation decision and help avoid shortage, excess, or dispersion because they are focused on the immediate future. Short-term forecast can be more accurate than long-term one, but they also need to be updated frequently. Then only they are beneficial. Next is long-term forecast. These cover more than 1 year. Long-term forecasting looks beyond the next 12 months and usually spans between 3 to 5 years or more. These forecasts are essential for strategic decision making, especially when it comes to a large investment, expansion plans, or major changes in the company structures. For example, predicting the growth over the next 5 years. If we see a manufacturing company might forecast expected demands for its products over the next 5 years to decide whether to build a new plant. These forecasts are based on broader economic trends, industry data, long-term customer behavior, and plan initiatives. Although long-term forecasts are less prescribed due to market uncertainty, they are still important for guiding the overall direction of the business and justifying big decisions. Comparison between short-term versus long-term. Short-term and long-term forecasting serve different purposes, but both are equal important. Short-term forecasting is more tactical. It focuses on today's needs, like managing cash flow, paying bills, scheduling shifts, or ordering supplies. It ensures that daily operations run without any interruption in daily routines. On the other hand, long-term forecasting is more strategic. It guides the business toward larger goals such as expanding to new regions, investing in new technology, or changing the company's products offerings. This forecast helps in making sure the business is sustainable and competitive over time. If a success successful company doesn't focus on just one. It it uses both types of forecasting together, ensuring that the short-term actions do not hurt long-term goals and that long-term ambitions are broken into manageable short-term steps. Going to next slide, qualitative forecasting. Based on qualitative forecasting is the method used when numerical data is limited on or unreliable, especially in new or uncertain situations. Unlike quantitative forecasting, which depends on statistical models and historical figures, qualitative forecasting is based on human judgment, experience, institutions, and opinions. This method is most useful for business launching a new product, entering new markets, or operating in industries where there is a little past data to rely on. For example, um, if we see a startup launching an innovative service might not have any past numbers to analyze. So they might depend on market experts, focus group decisions, or surveys to estimate customer demand and behavior. Uh, they don't have any other option they don't have any past data, so they want to rely on this data. So it is the qualitative forecasting help to them. The key sources in quality forecasting includes customer interviews or questionnaire, expert panels or advisory groups, industry reports and competitor insights, internal brainstorming with experienced manager. Why these methods lacks the mathematical prescription of data-driven models, it is extremely valuable when done with the right expertise and logic, especially for short-term planning or high uncertainty environment. The quantitative forecasting. Quantitative forecasting is a data-based approach that uses mathematical and statistical models to predict future outcomes. It works best when a company has sufficient and reliable historical data and when past trends are likely to repeat or remain stable. This method uses tools like time series analysis, moving averages, regression models, and trend analysis to produce future estimates. If we say example, if a clothing retailer has 5 years of monthly sales data, it can apply a moving average model to forecast the next season's sale. If there is a consistent seasonal pattern, the model can account for it and give a reasonable, accurate prediction. Quantitative forecasting is particularly useful in retail sales planning, budgeting and cost control, then inventory management. After that, financial forecasting for mature companies. It offers high accuracy in predictable environments, but may fail during sudden market disruptions like economic crisis, pandemics, or nature disaster, where past trends no longer apply. The comparison of qualitative versus quantitative forecasting. This slide highlights the key difference between the two main forecasting approaches. Qualitative forecasting is ideal for the situation that require insights, opinions, or creativity, especially when there is no reliable data. It is flexible, adaptable, and often used for early stage planning or during disruptive changes. On another hand, quantitative forecasting is analytical and scientific. It depends on patterns, trends in data, and is suitable for stable industries or businesses with the access to large data sets. In real world business practices, companies often combine both methods. For example, they might use a regression model, which is the part of quantitative data, to forecast product sales and then adjust the results based on feedback from marketing team and customer feedback. The hybrid approach improves accuracy and practicality. What is the benefits of forecasting? First, improving financial planning and control. Forecasting allows company to see ahead and build financial plans that are grounded in realistic expectations. It helps them project how much revenue they will earn, what their cost will be, and how much cash will be available at a different points in the future. With the insights, financial team can better control spending, reduce waste, and ensure that there is enough funding for critical projects and daily operation. Then the support protective business decision rather than understanding or reacting to problem after they occur. Forecasting empowers company to act in advance. For example, if we see if forecasts show this that sales will drop in the next quarter, the company can prepare by reducing expenses or increasing marketing efforts. It will help them to transform the mindset from being reactive to being strategic and forward looking. They don't get panic at the time of the drop of the sales. They can prepare before for increase their sales or reduce their expenses as they prefer. Then the next point is that help managing risk and uncertainty. Forecasting introduce discipline in planning for unexpected events by creating multiple scenarios, best cases, worst cases, and expected companies uh, can prepare strategic for each possibility. This reduces financial shocks and increases business reliance in changing environment. Then the optimize inventory and resource allocation. This is very beneficial benefit of the forecasting because I have seen means many companies have the problem of inventory management and resource allocation. They means if they do the inventory management and they forecast using forecasting, they don't have any interruption in their resource allocation. Accurately forecast prevent problems like understocking, lost sales, or overstocking. Similarly, they help ensure the right number of staff and resources are available when needed. Business can allocate manpower, raw materials, and financial resources in alignment with expected demand, improving information efficiency and reducing cost. So, in past time, I have visited a company where there is a problem of means stock problem, understocking because they don't have doing forecasting. At the time of production, there is shortage in inventory. At that time, if they do the forecasting before, they can arrange the inventory and the operation may run smoothly. There will be no any interruptions. After that, the builds investor confidence. Investors are most likely to support businesses that plan intelligently. Forecasted shows that the company is not just operating a guesswork, but is using data to make decisions. Well-prepared forecast shows how funds will be used and what returns are expected, making it easier to raise capital from investors or banks. For taking loans, they need to be have a plan or they need to show the plan to their investors and banks to show their numbers. How means how can they grow in future? It will help to build the confidence between investors. After that, enable strategic growth planning. The long-term success requires long-term vision. Forecasting helps companies plan growth strategies such as expanding to new regions, launching new products, or increasing production. These plans can be backed by projections, making them measurable and realistic. Going to next slide, limitations of forecasting. The forecasting means limited depends on quality and availability of data. Forecasting depends heavily on certain assumptions about customer demand, market trends, economic conditions, input cost. Assumptions are not guaranteed. For example, if a company assumes that inflation will remain stable but in unexpectedly spikes for forecast may become inaccurate because forecasts are built on the foundation of expectation and changes in the assumed condition can affect the outcome. Can be affected by external unpredictable factors. Short-term forecasts are usually more accurate than long-term ones because there are fewer unknowns in the near future. As this forecast horizon expands from months to year, external and internal variables changes significantly. Consumer behavior, competition, and technology may all shift, making long-term predictions harder to rely on. That's why business often revise long-range forecast every few months based on new developments. Relies on availability and quality of historical data. Forecasting models are only as good as the data they are built upon. If a company past data in inconsistent, missing, or inaccurate, the forecast will reflect those weaknesses. For example, if sales were unreported in a previous year, the projection will underestimate demand. Poor data collection or tracking can make even the best model unreliable. Then models may not capture quality insights. Many forecasting models are mathematical and data-driven, which means they may ignore or underweight qualitative factors like consumer sentiments, brand perception, and leadership changes. For example, company may look financial strong on paper, but might be losing customer trust due to service issues. Uh, for example, uh, these insights may not be reflected in a numerical model, but can still affect performance. Going to next slide, real world Indian forecasting wisdom. The first is Reliance Retail. In our Indian business environment, many successful companies are using forecasting to stay ahead of the competition. Uh, Let me explain how this actually works in real life. First, taking a Reliance Retail for example. With thousands of stores across India, they need to be sure that the right products are in the right place at the right time. They use forecasting tool to predict how much of each product will be needed in the region. This is not done by guessing. It is based on customer buying patterns, seasonal demand, and local festival. For example, during Diwali, the demands for sweets, dry foods, and decoration goes up. Forecasting helps them preparing in advance so they do not run out of stock or overstock and waste money. Now look at the Indian Railways. It uses forecasting to estimate how many passengers will travel during holidays, weekend, or exam seasons. This helped them to plan the number of trains and coaches needed. If they did not forecast, there would either be overcrowding or underutilization. Then the another strong example is Flipkart. During big sales event like the Big Billion Days, Flipkart receives millions of orders in just a few days. But how do they prepare for this? They use data from previous years like what people searched for, what they clicked on, and what sold the most. They combine this all with current web traffic trends and social media buzz. With this information, they can forecast which item will be most in demand, in which state, and in what quantity. This helps them stock up in advance and reduce delivery delays. Similarly, Mahindra and Mahindra, which makes tractors and agricultural machines, use forecasting based on monsoon forecast. If the monsoon is expected to be good, they forecast more tractor sales because farmers are more likely to invest in equipment. If rains are expected to fail, demand may drop. So they slow down production. As you can see, this example shows that forecasting is just a technical tool. It is a critical part of running a smart business. Whether it is agriculture, transport, e-commerce, or retail, forecasting helps Indian companies make better decisions, avoid losses, and satisfy customers. Then next slide, steps in forecasting process. Forecasting isn't something you do randomly. It is a structured process. It involves several logical steps and each one matters. Let me walk you through how it works in real life. First, we define what the purpose of the forecast. That means clearly understanding what we want to predict. Are we forecasting sales, inventory, staffing needs, cash flow? If we don't know what we are trying to forecast, the rest of the process will be meaningless. Clarity is the starting point. Next, we collect historical data. This step is about gathering past information that can help us to see patterns. For example, we collect monthly sales data from the last 3 years or visitors traffic to our website. This data can come from internal system like ERPM or CRPM or from external sources like government reports or industry research. Like many small businesses also use this historical data. They collect the historical data from their past sales. They see the patterns in their sales, how much they are selling online, how much they are selling offline. They collect all this. Then we analyze the trends in the data. We look for regular patterns. Maybe sales are higher in summer or during weekends, or drop sharply in off-season months. We also check for any upward or downward trends. These steps help us understand what really happening in our business environment. After this, we choose the right forecasting method. If we have a good data, we can use statistical tools like moving averages or regression analysis. If data is limited, we may rely on expert opinions or market surveys. The method depends on what kind of data we have and what we are trying to achieve. Once the method is chosen, the method is chosen, we use it to build a forecasting model and generate projections. These steps involve doing the actual calculation to estimate future results like next month's sales or how many people will need to hire in quarter 4. Then the forecast might be in single number or a range. But we're not done yet. We must review and validate the forecast. That means comparing the forecast to accurate results. If our forecast predicts 10,000 units in sales and we only sold 7,000, we need to ask what was wrong with data. Where are assumptions off? Did something change in the market? And finally, we update the forecast regularly. Forecasting is not a one-time task. As time passes and new data becomes available, We must revise and our forecast to so they stay relevant. Think of it as a GPS. You don't set it once and forget it. You keep checking if you are still on the right path. Time series forecasting in India. Now let's understand what time series forecasting is, especially how it is used in Indian industries. Time series forecasting is a method where we study past data that is arranged in a time-based sequence, like likely daily sales, monthly revenues, or yearly customer count. This type of data tells us how something changes over time, and by identifying patterns in this timeline, we try to predict what will happen in the future. This is different from random forecasting. Time series look like for consistency it focuses on three main things: trend, seasonality, and cycles. A trend is when the data is moving consistently up or down over a long period. For example, if mobile phone sales in India have been rising year after year, that's a positive trend. Seasonality is when we see repetition patterns within a year. In India, many products like air conditioner and cold drinks sell more in the summer, while sweets, clothes, and electronics spike during Diwali. These are seasonal trends. Then we have cycle, which are long-term ups and downs caused by economic changes like recession, election year spending, or a business boom. Let's look a few real Indian example where time series forecasting is used. The Indian Meteorological Department uses time series models to predict rainfall and temperature based on years of weather data. Farmer depends on this forecast to plan crop sowing. Retail chains like DMart and Big Bazaar use this method to forecast which products will be in demand at what time of the year, so they can stock their shelves accordingly. Even banks like SBI or HDFC use time series analysis to forecast demand for home loans, personal loan, or even interest rate movements. They look at past observable patterns and market data to estimate how demand will change in coming quarters. Another strong example is from the Indian railway system. By analyzing tickets booking over years, they can forecast peak travel periods like summer holidays or festival seasons, helping them plan extra training and resources. So to summarize, time series forecasting is like reading the financial calendar of the business. It's very useful in India because we have a strong influence of festival, season, and agriculture cycle. If a business know what is year usually looks like, time series forecasting help it to prepare stock, price, and deliver more efficiently. Going to next slide, forecasting in Indian crisis scenario. Let now look at how forecasting become even more important during times of crisis. We have seen this clearly during the COVID-19 pandemic in India. When the lockdowns were first announced in March 2020, mm, most companies were catch off guard. Regular forecast didn't work anymore. Business couldn't rely on month or yearly plans. Instead, they have to start forecasting on a weekly or even daily basis. Take companies like Swiggy and Zomato. With restaurants shutting down, they had to quick adjust their forecast. They started predicting how many delivery partners would be needed each day in each city, based on new rules and customer behavior. This helped them to avoid wasting money on either staff or disappointing customer with delay. Similarly, Dabur and Marico, both large FMCG brands, had to forecast product demand despite broken supply chains. For example, there was a sudden spike in demand for hand sanitizers and immunity boosters, like Chamanprash. They use forecasting model to decide which factories to run, how much raw material to source, and how to manage logistics under tight restrictions. Even pharmaceutical companies had to forecast the demand for medicines like paracetamol, and oxygen-related equipment, while also forecasting the risk of shortage. What we learn from this is during uncertain times, regular long-term plans lose their values. Business must switch to short-term flexible short forecasting and update models more frequently. They must also consider different scenarios. What if another lockdown happens? What if transport cost rises again? This is where scenario planning and contingency forecasting comes in. In a crisis, forecasting becomes not just a business tool, but a survival tool. It helps companies stay agile, protect their finance, and continue serving their customer even if in their tight, toughest times. Going to next slide, Indian startup and machine learning forecasting. Now let's talk about how Indian startups are using machine learning to take forecasting to the next level. Startups often work in fast-changing environment. Traditional forecasting methods like average or linear trends don't work well when customer behavior shifts quickly. That's where machine learning or uh, ML comes in. ML lets business using big amounts of data to find patterns and human analysts might miss. It also updates automatically when new data comes in, making it extremely useful for real-time forecasting. It is very fast process, so it is very useful to startups and companies. Let me give you some real Indian example of that. Dunzo, a hyper-local delivery startup, use machine learning to forecast order volumes and delivery times. Their system learns from traffic patterns, peak time behaviors, weather changes, and even local events like cricket matches or political rallies. Using all this data, they can decide how many delivery executives are needed in each area of the city. This helps them to avoid overstaffing or underperformance. Another great example is Zerodha, one of the India's biggest stock trading platform. They forecast server traffic using machine learning so their app doesn't crash during heavy trading session like IPO launches or budget announcement. Their system learns from past spikes and alerts the tech team in advance so they can scale up server temporarily. Startups like Ola and Rapido use machine learning to forecast rider demand and surge pricing. If they expect a surge in request in Andheri, Mumbai between 6 to 9 p.m., they increase prices and incentives to attract more drivers to that zone. This model trained on millions of trip records. What was what makes machine learning powerful is that it doesn't need fixed rules. It keeps learning and improving as more data flows in. This makes it ideal for modern businesses that rely on span, customization, and real-time decision. Machine learning forecasting allows works well for predicting customer churns, who is likely to leave your services, estimating product returns in e-commerce, personalizing product recommendation. So today, forecasting is just is is not just about spreadsheets. It's becoming a field that combines AI, big data, and automation. Indian startups are leading these changes by using machine learning to stay ahead of competition, cut cost, and serve customer faster. Now we will see the case study. One of India's most successful online grocery business, Big Basket. Big Basket faced a serious forecasting challenge. Before major Indian festivals like Diwali, Pongal, and Eid, Demand for certain products like sweet, oil, dry fruits, and gifting item goes up. But the company often struggle with managing inventory during this time. This issue was if they stock too little items went out of stocks, customers were unhappy and big basket lost revenue. But if they stock too much, items would expire or go to waste, especially perishable like milk or fruits. So big baskets start using advanced forecasting techniques. Past data, they take past sale data from previous devices, Google search trend data for specific grocery items, local weather predictions, which affect the demand for regional fruits and vegetables. They combine all this using machine learning models. What change come in there? Stocks outs reduced by 25%, which means fewer lost orders. One-time delivery improved by 18% because stocks was already in the right warehouse. Customer satisfaction scores improved. This case shows how real forecasting, when done smartly, can solve everyday business problem. It also shows that just relying on gut feeling is not enough in modern business. Data-driven forecasting, especially for demand planning and logistics, helps the startups uh, like big baskets stay competitive in highly crowded demand. In case study forecasting in Indian retail startup, this case study demonstrates how an Excel forecast model was applied to optimize demand forecasting for big basket. A prominent Indian real startup, the model leverages historical weekly demand data, particularly during a peak season like Diwali, to predict future accurately. If we see that there is a upward curve at the time of the season, so it helps them to arrange the stock as per this. Now let's talk about the most common mistakes that Indian companies makes while forecasting. This mistake may seem small at first, but they can cause huge problems like losses, excess inventory, missed targets, or unsatisfied customers. Using global models without local adjustment. Many Indian companies, especially new startups or multinational branches, they are try to use forecasting models built for foreign markets like the US or Europe. But Indian consumer behavior is very different. Here, religious festival, agriculture patterns, and cash-based transaction play a big role. For example, demand in India peak during Diwali, Holi, Navratri, and wedding season, not just around Christmas or New Year. If you don't localize the forecasting model, it will fail to predict these spikes, and the business will either underperform or overperform. Uh, the best example for this is the Ola, the Ola Electric. They launched their Ola Electric in India, but they do not forecast the means the Ola Electric means how should be it for Indian market. It is suitable for Indian roads or not. Its impact on Ola very badly. That's now the share of Ola that was come at 132 rupees is now at 40 rupees. If they do forecasting for changes in their Ola, then now they do not face this during this time. Then poor data collection and entry. Forecasting is only as strong as the data is based on any in many Indian small and medium businesses, data enter is inconsistent. Salespeople may not update record properly. Returns may be ignored, or PO's system may not track customer behavior. When we use such weak or incomplete data, our forecast automatic becomes weak. It's like likely trying to drive while looking through a dirty windshield. You will not see clearly. Then ignoring government policy changes. In India, government policy changes can have an immediate and massive impact on businesses. Take the example of GST introduction in 2017. Many companies did not forecast for changes in customer prices, dealer margins, and logistical cost. As a result, their original plans went wrong. Similarly, new rules in sectors like agriculture, banking, or import duties can change demand overnight. Forecast must include a policy watch element so you can adjust quickly. Then, fourth point, not factoring in seasonality and festival. Indian markets are heavily affected by religious, regional, and cultural events. For example, demand for clothes and electronic spikes around Diwali. Demand for ACs goes up in summer, while heaters sell more in North India during winters. If a company doesn't include these seasonal spikes in the forecast, they will either miss out on sales or get stuck with extra inventory later. Then there is also a point overconfidence in forecast. Sometimes company treat forecast like guarantee result. They build big marketing campaigns, stock huge inventory, or hire many employees based only on forecast without planning for uncertainty. But the truth is, all forecasts are based on assumption. If customer behavior or market trends change suddenly, the forecast can go wrong. So it is important to always have a backup plan or scenario forecast to handle worst situation. In the case of Ola Electric, the this was a new startup. They don't have the all data, but as per market data, if they have the forecast that many problems have occurred in their electric scooter, if they hire more employees in service center, it will helpful for them. But they do not hire the employees for servicing. It result in their downwards. Going to next slide. Forecast accuracy in Indian context. In India, many businesses are now not just making forecasts. They are also checking how accurate those forecasts were. This is called forecast accuracy measurement, and it helps company improve their prediction over time. Let's understand how this works with Indian example. The Reserve Bank of India regularly forecast inflation, interest rates, and GDP growth. To check if their predictions were correct, they use tools like RMSE, root mean square error, which tells them how far off their predictions were compared to actual outcomes. Similarly, FMCG companies like Hindustan Unilever and Nestle use accuracy tools like uh, ma- mean absolute percentage error to measure how close their sales forecast was to real month sales. If the forecast says they will sell 1 crore units of a product and they actually sell 1.1 crore, the error is small and acceptable. But if the real sales are only 70 lakh units, sometimes something went wrong and they must find out why. Stock exchange like NSE and to check how accurate their trading volume predictions were, especially during IPO days or budget announcement when traffic spikes. By checking forecast accuracy, regularly business learn from their mistakes. They refine their models, change assumptions, and use better data. Over time, their forecasts become sharper, which means better planning and fewer financial surprises. Now we move into model 3, techniques for financial planning and forecasting, which is in module 3 we will learn which is all about the tools and techniques that business use for forecasting. In this, forecasting is just guesswork. It's based on proper tools and scientific methods. Some tools are simple like Excel, while others are advanced like machine learning models. Some models work well when you have a lot of clean data. Other works better when you have limited data or fast changing situation. In this model, we learn companies use in India and globally different forecasting techniques like trend analysis, regression, scenario planning. So, going to next introduction to financial forecasting method. When we talk about forecasting in finance, we are talking about predicting what a company's financial future might look like in terms of revenue, expenses, profits, and overall growth. One of the most useful tool for doing this is something called a pro promo statement. These are basically what if version of financial statement. They allow us to plan ahead by projecting how much we will earn or spend if a certain condition happens, like launching a new product or expanding into a new city. Now, there are two main types of matter used to make this forecast. We divide them into qualitative and quantitative methods. Quantitative methods are based on data and numbers, things like past sales figures or statistical models. Qualitative methods, on the other hand, are based on the expert judgment, market observations, and business experience. Both methods are serve one important purpose. They help us to estimate how the business will perform financially in the future, whether it is for budgeting, investing, planning, or resource allocation. Forecasting gives us a solid base plan instead of judging guessing. Quantitative methods overview. Let's start by looking at quantitative method forecasting methods. These are the most commonly These are the most commonly used in corporate financial planning. Why? Because they are based on real historical data and statistical techniques. That means they give you results that the measurable, repeatable, and less influenced by opinion. Let's say you are forecasting next month's sales. If you have been tracking your monthly sales for the past 2 years, you can use the data to find a pattern or average, and that becomes the basis of your prediction. The big advantage of quantitative method is that they uh, they give you objective forecast. You are not relying on your gut or on guesswork. Instead, you are using solid numbers. So whenever you have good data from the past, like monthly revenue, cost trends, or customer orders history, qualitative forecasting is. So whenever you have a good data from the past, like monthly revenue, cost trends, or customer orders, quantitative forecast is the best and most accurate way to go. Now let's talk about the qualitative forecasting method. These are used when you don't have a lot of past data, or when you believe the intuition, expert knowledge, or outside trends are more important than just number. For example, let's say your company is about to launch a new product. There's no past data for it. Or maybe you are entering a completely new market like another country. In such cases, qualitative methods help you forecast based on things like what do industry experts think, what are competitors doing, what does customers research says. These methods combine business in instinct with market research. news, economic reports, and professional judgments. That makes them extremely useful in uncertain, dynamic, or new business situations. So while quantitative forecast may not give you exact number, they give you valuable direction, and that just as important when data is limited. Let me now explain one of the most commonly used forecasting method, the person sale of methods. This method is simple and easy to apply. You assume that certain financial line items like cost of goods sold, marketing expenses, or rent will grow at the same rates as your sales. Let us say your company sales are rupees 1 crore this year, and you expect them to go up by 10% next year. If your cost of goods sold is usually 30% of sales, then you would forecast next year cost of goods sold to be 30% of the new sales figure, which is 1.1 crore. So your cost of goods sold would be 33 rupees lakh. The same approach works for other items like admin expenses, advertising, salaries, if they usually stay consistent as a percentage of revenue. This method is very useful when your business expenses are directly linked to how much you sell. You want to create a quick promo income statement. You are in a growing business where past ratios are stable. But remember, this method assumes that everything grows in line with sales. So if there are fixed costs or one-time expenses, it will not always be accurate. Next up is the straight line method, another simple technique for forecasting. However, the idea is to assume that your revenue or any other financial metric will continue to grow at a constant rate, just like it has in the past. So, if your sales have been increasingly by 15% every year for the last year, you will project that this time 15% growth will continue into the next year as well. The formula is very straightforward. Next year revenue equals to the this year revenue into 1 plus growth rate. So this year if this year revenue is rupees 80 lakh and your past growth rate is 10%, you would forecast next year's revenue to be 88 lakh. This method works best when your business is stable and there are no major market changes. Expected you want to do quick long-term planning, but there the limitation. It doesn't consider real world disruptions. What if a competitor enters the market or demand falls due to an economic slowdown? The straight line method would not account for these changes. That's why it's a good starting point. But we should also use another tools to adjust the forecast for real situation. Moving average method. Let's now talk about the moving average method. One of the simplest and most practical forecasting tool out there. This method works by taking the average of past results and using that to predict the future. It's like saying, if I want to know that might happen next month, I will look at what happened over the last few months. And those numbers are divided by how many months I use. That gives me an average, a reasonable guess for what's coming next. The formula is simple. A1 plus A2 plus A2 plus all, where A1 to AN are actual data points, like sale figures, and N is the number of periods. Now, for example, if your last month sales of sales were 80,000, rupees 90,000 and 1 lakh, then your forecast for next month will be 80,000 plus 90,000 plus 1 lakh divided by 3. It will be 90,000. This method especially This method is especially helpful for short-term forecasting, and it works really well when your business experiences regular seasonal trends, like sales going up during festival or down during off-seasons. It's easy to use in Excel and great for planning inventory staffing or short-term cash flow. But one thing to note, it works best when your data is stable. It doesn't respond well to sudden market shifts or volatility. Next, we have the simple linear regression method, which helps you understand and measure the relationship between two variables. Imagine imagine you want to know, does my advertising spends actual affects my sales? This method lets you answer that question with maths. The formula is y equals to bx plus a, where y is what you are trying to forecast, like sales, x is what independent variable like ad spend, b is the slope or rate of change, and a is the intercept, the best value when x is 0. So if you spend rupees 1 lakh, 1 lakh on advertising and it leads to a rupees 5 lakh increase in sales. Regression will help you estimate how much more sales you will get if you spend rupees 2 lakh. This method is great for forecasting based on cost-effect relationship, such as how does price affect demand, how do store footballs affect daily sales, how does social media spending affect website traffic. Just remember, this method assumes the relationship is uh, linear and consistent, and it only works for one influencing factor at a time. For more complex scenarios with multiple factors, we use multiple regression. The weighted moving average is likely an upgraded version of the moving average method. In the simple moving average, we give equal importance to all past data points, but in many real life cases, recent data is more important. What happened last month matters more than what happened 6 months ago. This method shows that by giving more weight to recent periods and less to older ones, so you are still averaging, but you are doing it smartly. Let's say you are assigning 50% weight to the last month, 30% weight to month before that, and 20% to the one before that. This makes you forecast more responsive to current trends, especially in markets that are changing fast, like fashion retail, technology products, or even food delivery apps during seasonal spikes. This method is highly useful in violent environment uh, where customer behavior demands shift it. It commonly applied in demand forecasting, revenue projection, and dynamic pricing model. The key here is to choose your weightage carefully. Too much emphasis on recent data might ignore long-term patterns, and too little might make the forecast slow to respond. Now we move into a more advanced method, multiple linear regression. This is a perfect for when your forecast is influenced by more than one factor. Let's talk an example. You are forecasting sales, but you know it's not just advertising that's affect them. Price discount, seasonality, competitor pricing, and customer reviews also plays a role. Multiple regression allows you to put all those independent variables into the equation to forecast your independent variable like sales or reports. This gives you a more realistic and accurate forecast, especially in complex industries like telecom, insurance, or automobile. Manufacturing, where many different forces affected performance at once. But for this matter, at you must ensure a linear relationship exists between each input and the output. There's low multi-set, meaning your input variable should be too closely related to each other, like price and discount together. They can confuse the model. Multiple regression is data heavy and works best in the tools like Excel with data analysis tool pack, Python or R. But if done right, it can give you deep insights into what are really driving your business outcome. The Delphi method is a qualitative forecasting technique, and it is all about getting expert opinions and turning them into future prediction. Here's how it works. A group of experts is selected. They are given questionnaire in multiple rounds. After each round, a facilitator summarize the response and share it with the group. Experts then revise their answers, considering their feedback from others. This continues until the group reaches a consensus or at least their opinions start to align. The Delphi method is perfect when you are dealing with uncertain or brand new situations, like forecasting the success of a new technology or predicting future policies impacting in an industry. It's commonly used in R&D, strategic planning, or and crisis forecasting. What makes it powerful? Is that it combines expert intuition without direct confirmation. So no one dominates the conversion and everyone contributes freely. Finally, let's understand the market research method, another qualitative forecasting technique and one that is especially valuable for startups or new product launches. This method involves conducting surveys, analyzing consumer behavior, running for focus groups, studying buying patterns and preferences. When a company doesn't have past data like a startup or a firm launching to a brand to a brand new service, market research becomes them primary forecasting tool. It helps them to what their consumer want, how much they were willing to pay, and how often they will buy. For example, if you are starting a new health food brand, market research might tell you that people in metros are willing to pay more for organic snacks, and that demands peak during January, New Year resolution seasons. This information helps you to forecast production price and even marketing strategy. Market research adds human context to forecasting. It gives you insights that no Excel formula can provide. That's why it often used alongside quantitative data to create a more complete and practical forecast. Introduction to trend analysis. Let's now dive into one of the most important tools in financial forecasting, trend analysis. So, what exactly is trend analysis? Simply, but it is the process of looking at data over a period of time, like sales, revenue, cost, or customer numbers, to see if there's a consistent patterns forming. We are trying to understand whether our business is growing, shrinking, or staying the same. Let's say you run a clothing store. If your monthly revenues has been increasing slowly every month for the last 2 years, that's a growth trend. If your football drops every winter, that's a seasonal trend. Trend analysis help you see this pattern clearly and use them to make better decisions. It allows you to answer questions like, are efforts working? When do our sales peak? Are costs rising too fast? You will often see trends analysis used in areas like sale performance, revenue forecasting, expense management, customer data, and traffic flow. This is not all about guessing. It's about spotting reliable, repeatable behaviors in your data and acting on them. Purpose of trend analysis. Why do we do trend analysis? What's the goal? The main purpose is to forecast future of performance using historical data. If you know what's been happening consistently in the past, you can make a good guess about what might happen next and plan for it. Trend analysis also helps you understand business cycles. Maybe sales dip in the summer but rises again during Diwali. Or maybe there's a 3 year cycle of growth followed by a slowdown. When you are recognizing these patterns, you can plan production, hiring, and marketing efforts accordingly. Another benefit is that it helps you to set realistic business goals. If you know your sales have been growing at 8% every year, you will not randomly aim for 30% next year because it would not be practical. Trend analysis help you stay grounded and data driven in your planning. And finally, one of the most powerful uses is early problem detection. If your trend line is flat or declining, maybe your average order size is going down. You will catch it early. That gives you time to investigate the problem and fix it before to become serious. Now looks at different types of trends you might come across when doing trend analysis. Upward trend. This means that your data is rising steadily over time. It could be sales, website traffic, customer customer signs up, anything that improving. An upward trend is usually a good sign of business health, growth, and customer demand. Example: sales growing from rupees 1 crore to rupees 1.2 crore to rupees 1.5 crore over 3 years. Then downward turns. This is warning signal. Sometimes it's constantly falling. It could be profit margin, product rating, or even customer retention. If it keep going down and you do not act, this business will suffer. Horizontal trend, also called a flat or practical trend. Here, your numbers do not change much. They stay in the same range over time. This might sound okay, but it also means there's no real growth. It's like being stuck in one place. Seasonal trend. This is when your data follows a predictable pattern that's repeat every year. In India, we see strong seasonal trends like Diwali sales for growth and electronics or cold drinks. Sales rising in summer. Recognizing this helps you plan inventory ads and staff hiring in advance. Understanding these four types of trends giving you powerful insights. You will know where to grow, where to cut, and where to double down. Okay, now let's learn how to actually do trend analysis step by step. First step is collect monthly or yearly data. Start by gathering data in a time-based format. For example, monthly sales from January 2022 to December 2024. The more consistent your data, the better. Use line graphs to plot the data. Next, use Excel or Google Sheets to create a line graph. On the x-axis, you will put the data, months, and y-axis, you will put the revenue or cost. Then, look at the slope or direction. Check whether the line is moving up, down, or flat. A rising slope means upward trend. A falling slope means a downward trend. If the line jumping up and down a lot, you may need to smooth it out using moving averages. Use Excel trending line. Use Excel's trend line feature. This is where Excel becomes very helpful. You can add a trend line to your chart, linear or exponential in the formula project formula values. Let's finish this section with a simple business example that ties everything together. Suppose a company tracks its monthly sales from January 2021 to December 2024. After plotting the data, they notice that every year sales have gone up steadily. On average, they are going about the 12% each year. This is clearly upward trend. Now, based on this trend, the company makes an informed decision in 2025. They decide to invest in more inventory and increasing market spending because they expect this growth to continue. They don't just invest blindly. They do it based on trend analysis. This shows how business can use simple trend analysis to prepare budgets, manage inventory, plan marketing campaigns, set future sales targets. The beauty of this method is that it's simple, visual, and grounded in real numbers. What is ratio analysis? Let's now understand a practical and powerful tool in finance is called ratio analysis. So what is it? In simple words, ratio analysis is a process of comparing different numbers from a company's financial statement, like the balance sheet and this income statement, to evaluate how well the business is performing. Imagine you have a business, you have got all these big financial numbers, revenue, expenses, assets, liability, and more. Just looking at these numbers individually will not always give you clarity, but when you are comparing them using formula, that's where you will get deep insights. For example, if you divide by net profit by revenue, I know the percentage of my sales I actually can keep as profit. There are four major categories of financial ratio, and each one looks at a different part of business performance. Profitability ratio. This ratio tells us how good the company is at making profit. One example is return on assets (ROA), which tell us how much profit the business earn from every rupee of assets. The higher the higher this ratio, the better the company is at converting assets into profit. Other company profitability ratio, net profit margin, gross margin, return on equity (ROE). Then second is liquidity ratio. Liquidity ratio is about how easily a company can pay in short-term bills. A company ratio, high quick ratio, which shows whether the business has big enough quick access assets like cash or receivables. to come or upcoming liability. If liquidity ratio are too low, the company might struggle to pay salaries or rent. Then the solvency ratio. Solvency is about the long-term survival. Is the company carrying too much debt or is it financial balance? Debt to equity ratio is a key solvency ratio. It compares the how much of the company capital comes from loan debts versus owners equity. High debt can mean risk. Low debt could mean missed growth opportunities. So this ratio helps you understand your financial risk long term. Fourth, efficiency ratio. This shows how well the company is using its resources like inventory, machinery, or employee time. For example, the asset turnover ratio tells you how much revenue is generated for every rupee of assets you have. Higher is usual better. It means the company is squeezing more out of what it owns. Efficiency ratio helps track productivity, resources use, and day-to-day operations. Examples of now let's go over some of the most important ratios that every business should know and track. Net profit margin formula for net profit divided by revenue into 100. This tells us what percentage of your total revenue turns into actual profit after all expenses are wrapped. If your net profit margin is 15%, it means for every rupees 100 you earn rupees 15 stays as profit and rupees 85 goes towards expense like rent, salary and electrical etc. Then current ratio. Formula is current ratio divided by current liabilities. This is all about short-term health. Can you pay off your bills that are due in the next 12 months using your current resources? A current ratio above 1 is usually good. It means you have more assets than short-term debts. Debt to equity. Total debt shareholder equity divided by shareholder equity. This shows how much of your business is funded by debt versus owner's investment. A ratio of 2 means you are using 2 rupees 2 of borrowed money for every rupees 1 of owner's capital. High ratio means higher risk, especially if interest rates high rises or income slows down. This three ratios, profit margin, current ratio, and debt to equity, gives you balanced view of your profitability, liquidity, and long-term financial risk. Now we will take a break of 5 minutes. Now you might ask, why should we spend time doing all this ratio analysis? The answer is simple. It gives you a quick and clear snapshot of your company's financial health. Without going deep into every financial statement, you can use a few key ratios to understand whether the business is growing stable or in trouble. If your debt to equity ratio is rising fast, it may mean your business is borrowing too much. If your profit margin is falling very every quarter, you may be overspending or pricing too low. Bankers and investors use ratio analysis before giving loans or fundings. Bankers and investors use ratio analysis before giving loans or fundings because it gives them a clear picture of how risky or safe the company is. So, in short, ratio analysis is not just for accountants. It's for every manager or entrepreneur who wants to run a smart data-driven decision. Let's now understand what is moving average. A moving average, because this is one of the most commonly used tool in financial forecasting, budgeting, and even in stock market analysis. A moving average is simply a technique that makes a set of numbers, like wisely, like weekly sales or daily stock prices, and calculates their average over a specific time period, such as 3 days, 5 weeks, or 12 months. The main reason we use moving average is to smooth out the data. Real world data often jumps up and went down because of many short-term events like one big scale, a sudden discount, or a special festival offer. These are called fluctuations or noise. A moving average helps reduce that noise so we can see the actual trend more clearly, like whether sales are really going up or down in the long term. The main reason we use moving average is to smooth out the data. Real world data often jumps up and down because of many short-term events, like one big sale, a sudden discount, or a special festival offer. These are called fluctuations or noise. A moving average helps reduce that noise, so we can see the actual trend more clearly, like whether sales are really going up or down in the long run. Think of it like looking at a hilly road without a moving average. You only see the bumps and drops. But what if you see the general slope, which way the road is heading? In finance, this is used to analyze trend analysis in stock prices, track monitor or weekly sales, monitor budget performance, understand customer behavior over time. So, a moving average is just a match. It's a decision-making tool that help us to see the big picture. Now you may ask, why exactly do we use moving averages? What benefits does it give us? Here are the three main reasons. First, to identify trends. If you want to know whether your sales are increasing or decreasing, a moving average can help in it. To reduce noise, every business has ups and downs, but not every fluctuation is important. A moving average helps cancel out the small spikes and dips and focus on the what happens happening overall. To make to make better forecasting decisions, whether you are planning next month's inventory, preparing a sales target, then third is to make better forecasting decisions. Whether you are planning next month inventory, preparing a sales target, or deciding when to launch a promotion, having a smoother and clear view of your past performance and help you to predict better. There are two main types of moving averages that we usually use. First is simple moving average. This is the basic version. It takes that It takes the total day of the data over a fixed number of periods, say 3 weeks or 5 months, and divides it by that number. It's give a equal weight to each period. Example, if your sales for growth for 3 weeks are 10,000, 20,000, and 30,000, the simple moving average is 10,000 plus 20,000 plus 30,000 divided by 3 will equals to 20,000. Every time you add a new data point, the oldest one is dropped, and the average moves forward like a window sliding ahead. Then come to second point, exponential moving average. This is slightly more advanced version. The exponential moving average gives more weightage to recent data, which means it reacts faster to new changes. Why is this useful? Let's say something major happens, like a sudden spike in order or a price change. The exponential moving average will reflect that shift sooner than the simple average. It's more sensitive to current market conditions. Especially used in stock market analysis, fast changing sales, environments, and daily revenue trackings. So the difference is the simple moving average is simple, stable, and easy, and the exponential moving average is faster, smarter, and more reactive. Let's go through a simple example of how simple moving average works, so you can see it in action. Suppose your work weekly sales for 4 weeks are week 1 rupees 100, week 2 rupees 150, week 3 rupees 130, week 4 rupees 120. Now, if we want to calculate a 3 week moving average, we start from week 3 because that's when we have enough data. Week 3 SMA is equal to 100 plus 150 plus 130 divided by 3 will equals to 126.67, and the week 4 simple moving average is equal to 150 plus 130 plus 120 divided by 3 will equals to 133.33. So as the weeks move forward, we drop the oldest value and add the newest one. This moving windows gives us a smoother view of how sales are trending. Now, not, notice that this average don't jumps around as much as the actual sales numbers. That's exactly the point, to show the real direction without distraction. Let's now look at some real life examples of moving average are used in business and finance. Inventory planning. A retail company may use moving averages to track averages sales and decide how much stock to order in next month. It prevents overstocking or running out of products. Sale forecasting. Business use it to set future sales target. If the 3 months average sales are rising, they plan more aggressively. If it's falling, they adjust expectations. Stock market investing. Traders use moving averages likely like 50 days or 200 days. Moving averages to decide when to buy or sell stocks. If the current prices crosses the average, if it could mean a new trend is starting. Budgeting and profit planning. Finance teams use moving averages to track expenses and profits and adjust budgets based on actual performance, not just projection. Performance dashboard. In marketing, HR, and operation, moving average helps team monitor trends, whether it employs turnovers, customer engagement, or website traffic. So, whether you are running a business, investing money, or tracking performance, moving average are a smart way to get clear view of the road ahead, especially when raw materials are all over the place. Now let's learn about the powerful tool, scenario and sensitivity analysis. These tools are used when we want to answer the question, What will happen if things we don't go exactly as we plan? Because the future is always uncertain and real business environment change. Maybe your sales are lower than expected, maybe cost rise, or a competitor enters the market. So instead of making just one forecast, we test different possibilities. Here's the difference: scenario analysis and sensitivity analysis. Scenario analysis is about exploring different complete situations. For example, a best case scenario where sales are great, a worst case scenario where costs are high, and a base case where everything goes as unexpected. Sensitivity analysis is more focused. It checks what happens when you change just one input like sales or cost per unit while keeping everything else the same. Both tools helps you plan for uncertainty, reduce risk and make decisions more confidently. Now how to create scenarios. Let's go through that how actually build a scenario analysis in four simple steps. First, define key drivers. Start by, start by identifying the most important variable that affect your financial result. This could be this could include sales volume, selling price, cost of raw materials, marketing expenses, exchanges, rates, retails. These are four key business drivers. Small changes in them can make a big impact. Build a financial model. Now using Excel or any financial planning tool, create a model that connects your input like a sales or cost per unit to outputs. The model should have formulas so when you change an input, the final outcome also changes automatically. Now you create different scenarios by changing your key inputs. Best case, high sales, low cost, good market condition. Best sales, normal expectations. Worst case, flat sales, rising cost, maybe some external risk. This give you a range of possible outcomes. Fourth, compare outcomes. Once you have built your scenarios, compare the result. Use charts, tables, or dashboard to clearly see how the outcome differs. Which scenario gives you the best profit? Where your risks are highest? And what your break-even point look like under the different conditions. By doing this, your business is no longer reacting to surprises. It's already prepared for them. Let's now focus deeper on scenario analysis itself. This tool helps you explore how your financial results would change if difficult situations occur. It like asking, what would happen to my profit if the market growing faster, or what if the raw material prices double? It works by changing multiple variables in your model, like sales cost or pricing, and seeing how for number. Why is scenario analysis is important? It prepares you for uncertainty instead of planning for what you hope will happen. You are ready for multiple outcomes. It helps you with risk management. If you know what could go wrong, you can prepare in advance. It enables smarter decision making. When you compare outcomes under different assumptions, you can choose the most realistic and safe plan. This is especially useful in budgeting, forecasting, and strategic planning. For example, during COVID-19, many companies use scenario analysis to plan what they would do if there was another lockdown or if demand fell sharply. Those who plan those who plan were able to adjust faster and survive better. Now let's look the different techniques you can use with scenario analysis. Best case, worst case, base case. This is most common use method. You create all these three cases. This helps you to stay ready no matter what happens. Then second is what if analysis. This is like mini scenarios. You ask questions like what if sales falls by 10%? What if raw materials become 15% more expensive? You tweak one or two inputs to see how much it affects your profit or cash flow. Third is Monte Carlo simulation. This is an advanced technique. Instead of running 3-4 scenarios, you run hundreds or thousands using random inputs based on profitability. This gives you a risk profile. It useful in a complex environment like financial portfolio or insurance. Fourth is driver-based modeling. This is a smart way to focus only one key drivers like price, volume, or a hair count that directly affect performance. Instead of changing everything, you focus on the 2 to 3 variables that move the needle. Each of these techniques can be used depending on your business size, tools, and complexity, uh, all of them all of them helpful to prepare before a crisis, not after. Let's take a real world business example to see how this works. Imagine a company XYZ Limited. They want to forecast profit for the next year, but they ensure how the market will behave. So they created three scenarios. Best case, sales are high, costs are under control, and result profit increase. So they plan for expansion and maybe invest in marketing. Then best case, we see that sales growth is moderate 10% and cost increase slightly from 5 to 8%. So it results that profit is steady. They maintain current strategy and monitor the market. The worst case, the sales remain flat, raw material prices go up by 4% more, and result profit drops. They plan cost cutting, delay hiring, and avoid big investment. This kind of planning helps management stay calm and in control even when the market behaves unpredictability. Instead of reacting in panic. They already have a game plan for every possibility. That's the real power of scenario analysis. To prepare, not predict. Now let's talk about sensitivity analysis, a tool that's simply but extremely powerful when it comes to financial decision making and planning. So what is it? Sensitivity analysis is the method we use to check how much a change in one input affects the final financial outcome, like profit, cost, or cash flow. We do this by changing just one variable at a time, while keeping everything else the same. That's what makes it different from scenario analysis, where we change multiple variables together. For example, if I increase the selling price by rupees 10, how much will my profit increase? Or if a raw material cost goes up by 5%, how much will my total cost increase? The technique helps us answer those questions, and more important, they help us. In short, the sensitive analysis is like pressure testing your financial model. You poke it in one place and see what happens, and then You know where to focus your attention when you are making decisions. Let's uh, let me walk you through a simple example to show how this work in practice. Rupees 100 per unit, rupees 110 per unit, and rupees 90 per unit. And each time they check the new profit results while keeping other factors like cost, units sold, and marketing the same. This analysis show that as the selling price goes up, profit increase slightly. That means profit is very sensitive to price. These insights are is here is powerful. If a small increase in price gives a big profit boost, it helps the company that pricing is critical business lever. So this type of analysis help management focus on the right variable. In this case, they might increase price slightly, offer premium package, reposition the brand for the better margins. It also works the other way. If costs are highly sensitive, you know you need to negotiate with suppliers or find more effective materials. The key differences. Before we finish, let's clearly understand the key differences between scenario and sensitivity analysis because both are important, but they serve different purposes. Scenario analysis. Change multiple inputs at the same time. Goal is to see post future like then use most used mostly for risk planning and business strategy. Help you prepare for different real world situations. For example, what happens if sales drop and cost rise and taxes increase? Then sensitivity analysis changes only one input at a time. Goal is to measure the impact of that one variable. Helps identify which factors affecting your result the most. Used for the focused decision making and risk testing. To somewhere, for example, what happens if only price changes or only material cost? So now that we have learned about scenario analysis and sensitivity analysis, the big question is why do these tools matter so much in the real life business? Well, here the thing, business is full of uncertainty. No matter how good your business is, things changes, price goes up, customers behave differently. Now competitors enter the market or policies shift. That's where these tools become extremely important. They help you to stay prepared, not shocked. First, help the business plan for risk and uncertainty. Instead of creating one fixed plan and hoping for the best, you build flexible models. You ask, what if sales drop? What if cost rise? What if demand doubles? By preparing for multiple situations, you are ready to no matter what happens. And that's how smart business stay. Second, they improve decision making. With these tools, you don't rely on guesswork. You don't say, let's hope this will work. You say, if two input changes here, the impact. So we will take the safest or most profitable route. Whether it's pricing, cost cutting, or expansion, your decisions are backed by data and models, not just gut feelings. They are used in budgeting, forecasting, and investments. These tools are regular part of budget planning, helping you to allocate funds wisely, sales forecasting, helping you predict based on real scenarios, investing analysis, checking risk before spending money. Companies use them to justify funding, presence to investor, and guide strategic growth. They help manager to prepare and surprises. Imagine a manager who only plans for perfect outcome. The moment sometimes goes wrong, a delay, a price hike, a demand drop, they stuck. Now imagine a manager who already built a worst case and best case scenario. They have thought about different situations and already have a response plan ready. The manager doesn't panic and they adjust quickly and keep moving. That's why these tools are important. They do not eliminate risk, but they help the manager in smartly.